The tax accounting equation, or TAE, is a fundamental concept in accounting. It helps us understand the relationship between a company's assets, liabilities, and equity. In simple terms, the TAE states that assets are equal to the sum of liabilities and equity. This equation acts as the foundation for creating financial statements. These statements provide a snapshot of a company's financial health at a specific point in time. Assets represent what a company owns, such as cash, inventory, or buildings. Liabilities, on the other hand, represent what a company owes to others. This might include loans, accounts payable, or salaries payable. Equity represents the owner's stake in the company. It reflects the residual interest in the assets of the entity after deducting liabilities. The TAE is crucial because it ensures that a company's accounting records are balanced. Every transaction that a company makes affects at least two elements of the accounting equation. This double-entry bookkeeping system helps to prevent errors and ensures the accuracy of financial reporting. Understanding the TAE is essential for anyone involved in business, whether you are an investor, a manager, or an entrepreneur. It provides a framework for understanding financial statements and making informed decisions. The tax avoidance hypothesis suggests that companies try to minimize their tax burden. They do this by exploiting loopholes and ambiguities in tax laws. This practice, while often legal, raises ethical concerns. It can deprive governments of much-needed revenue. Companies use various techniques to reduce their tax liabilities. One common method is income shifting. This involves transferring profits to subsidiaries in low-tax jurisdictions. Another method is transfer pricing manipulation. This occurs when companies adjust the prices of goods and services exchanged between related entities to shift profits. The tax avoidance hypothesis highlights the challenges governments face in designing fair and efficient tax systems. It also underscores the importance of transparency and accountability in corporate tax practices. Let's consider a hypothetical example to illustrate how companies might manipulate transactions to lower their tax liability. Imagine a multinational corporation, tech giant, operating in both high-tax and low-tax jurisdictions. Tech giant establishes a subsidiary in a low-tax haven and transfers its valuable intellectual property to this subsidiary. Now, when tech giant sells its products or services globally, it routes the transactions through its low-tax subsidiary. The subsidiary then pays a royalty fee to the parent company for using the intellectual property. This royalty fee is set at a level that shifts a significant portion of the profits to the low-tax jurisdiction, reducing tech giants' overall tax burden. This example demonstrates how companies can exploit differences in tax laws across jurisdictions to their advantage. While such practices might be technically legal, they raise ethical concerns about fairness and transparency. And given the potential for manipulation, it is crucial to carefully examine the financial statements of companies, particularly those operating in multiple jurisdictions. Regulators, investors, and other stakeholders must be vigilant in identifying red flags that might indicate tax avoidance practices. One area of focus should be related party transactions. These are transactions between entities that have a pre-existing relationship, such as a parent company and its subsidiary. As seen in the tech giant example, related party transactions can be used to shift profits and reduce tax liabilities. Another red flag is the use of complex corporate structures involving multiple layers of subsidiaries, especially in tax havens. While these structures might serve legitimate business purposes, they can also be used to obfuscate ownership and financial transactions, making it difficult to track profits and assess tax liabilities accurately. In conclusion, while the tax accounting equation provides a fundamental framework for understanding a company's financial position, it is not immune to manipulation. The tax avoidance hypothesis highlights the incentives companies have to minimize their tax burden, often through complex and opaque transactions. Therefore, it is essential for stakeholders to approach financial statements with a critical eye, scrutinizing related party transactions and complex corporate structures to ensure transparency and accountability in corporate tax practices. Professional tax advice is paramount in navigating this complex landscape and ensuring compliance with tax laws.